Okay, got the recording going. So again, Paul Krause for Annabelle Pacheco's Get Your First Multifamily Investing Deal. And this week we're going to be talking about how with these banking emergencies that are going on, why it's super important for our group to be engaged in not only the headlines of what's happening, but also engaged in how to take this information back to your business and how to apply it to your business. Just a quick group from the group, show of hands. Is anybody right now in escrow on any deals that require any kind of bank financing or bank lending or mortgage lending of any kind?
I just closed one on Friday, and that one was even, they were trying, it was supposed to be a cash deal and they ended up changing it to financing. And at the last minute, they were trying to get an extension, and I think something was brewing. So, I was a listing agent. So, excuse me, I ended up sending them a demand to close because they were trying to extend it. After getting 1 week extension, they're trying to extend it for another week. And I thought something's not right here. They're probably messing around with their capital, or maybe they have other investments going on. This was a 4-unit building and 4-unit multifamily. So I wanted to make sure I got it closed because yes, all this news is coming about. So you just don't know what's going to happen.
No, we don't. And I don't have the crystal ball either. But thanks for sharing that. Just out of curiosity, what marketplace was the property in?
In Huntington Park, LA County.
LA County.
This was a foreclosure property that, we had 30 more days to close it before the notice of sale gets recorded. And so my client was an elderly senior client, and she was just really trying to unload the property and cash out on her equity, which was about $410,000. So as you can see, there was a lot on the line, and I couldn't waste any time with, the buyers trying to get another week extension.
Sure. Yeah, and I know what it's like to go and have to ask for extensions. Sometimes sometimes you have to do what you have to do, and sometimes you run out of favors and you can't get an extension. So congratulations, Patricia, to you, because you probably slept a lot easier knowing that escrow had closed and you had recorded.
Oh yeah, absolutely. I mean, we did grant them one extension, which was for a week.
Okay.
And that's because they said we're going, we were going to close cash, but we ended up allocating some of our capital to other investments. And so now we're getting a loan. It's a hard money loan. We should be ready to close in a week. But after 3 days of that 1 week extension, the lender still had no update on when they were going to send documents to escrow. And I thought, wow, 3 days into the week extension, they still don't have any idea. And they're still, playing around with the numbers, and they were going to do a holdback for the rehab they were going to do. And so it just didn't seem, then they asked for another extension, and I said, no, you're getting a demand to close, and that's it.
I get it. Well, congratulations. That's a great deal story.
And they closed, after they got the
fantastic that they closed. Okay,
yeah,
good.
got it together.
I just want to go around the horn real quick. Lemuel, what marketplace are you investing in, or are you in right now? Lemuel?
Can you hear me?
Yeah, I can hear you.
Hello?
We can hear you.
I'm driving, unfortunately, and listening to you guys. But yeah, I'm working out in the Corona area, the Riverside, the San Bernardino area.
Okay, great. Thank you. And Jennifer, how about you? What marketplace are you in?
Well,
And Jennifer dropped off. Ahmad, a whole bunch of people are dropping off. Natalia, what marketplace, Natalia, are you in?
I'm here. Can you hear me?
Yeah.
This is Ahmad. I'm in Los Angeles, Southwest and Mid Cities area.
Sounds good. And Natalia, how about you? What marketplace are you in? Natalia, are you with us? Natalia.
She typed in the chat, she said LA.
Okay, got it. Hey, Cynthia, thanks for joining. We're just going around the horn real quick. What marketplace, Cynthia, are you calling in from today?
Hi, Ohio.
You're in Ohio. Okay, great. And we have, I think, one more. Okay, so we have Jay joining. Hi, Jay. We're just going around the horn real quick. What marketplace are you calling in from today? Oh, he's connecting to audio. Hi, Jay. Do you hear us okay?
Hi, yes, I can. Thank you for adding me so quickly. I appreciate that.
Oh, no problem. What marketplace are you calling from today?
I'm in the Philadelphia, Pennsylvania region, so it's
Oh, got it. You're 3 hours ahead. Okay, great. So I just want to get a feel for where everyone's at, because today, again, for the people who just joined, what we're going to be talking about today is what's going on with the banking crisis that's going on. Obviously, 2 banks just got taken over from last week. I want to talk about how it's going to impact and how it's going to affect multifamily investing, because absolutely we are a capital intensive product. We need capital to move deals, and whether it's the capital of the seller who's offering seller financing, or if it's the capital of the bank to go get a loan, absolutely it is going to impact our business and what's happening. But I want to bring us back to some very, very basics, because by understanding the basics and the concepts that are related to the basics, we can take the information and it'll help us to understand how we can apply it to our business. So let me go ahead and share my screen. And I'm going to go into my notes here, and everyone should see my notes, which says Bank A, checking account, $1 million. Does everybody see that?
I could see it as well.
Yes,
Okay,
I can see it.
perfect.
I can see it.
Yes.
Okay, great. So we are going to talk about some basics right now. So how does lending work in general? Well, the way bank lending works in general is a bank receives a certain amount of deposits. So I just happen to call it Bank A checking account. That Bank A checking account I totaled is $1 million. So how does a bank go and loan money? Well, a misunderstanding about how banking works is that people think that what they do is that they go take the amount of money, and then 9 times that amount they go lend out. It's actually not how banking works. Money is created, cash is created, and they're allowed to create it at a multiple that the Fed Reserve and the banking industry allows them. Now, I'm not a banking insider, I'm just going by modern money mechanics, but basically what they do is they go and create $900,000 off of a $1 million deposit. And so now the bank has $1 million to go lend. Okay. Did they take the deposit and go give that deposit to some other institution? No, they went and created from that $1 million more money. This is called fractional reserve banking. They went and created that $900,000, and they can now lend that out. Does that make sense to everybody? And if it doesn't, just let me know. Someone just called in on 949. Can you hear us okay?
I can hear you okay, yeah, thank you.
Oh, okay. And who's this?
This is Natalie. I wasn't able to talk, so don't kick me out, please.
Oh, okay. No problem. No problem.
Okay.
We just want to make sure we don't have spammers, that's all. I'm going to mute you right
No.
now, though, okay?
Okay, thank you.
Okay.
Could you repeat that again, please? so it can sink in a little bit more?
Yeah, absolutely. So banks create money out of money. They don't go lend their own money, because if they went and lent their own money, they couldn't create more money. They would have to go to the Federal Reserve to go get more money through the form of a loan, or they'd have to go to the Treasury Department, which prints the money and creates it through an act of Congress. So let's go back to the very beginning. Bank A checking account has $1 million deposit. In other words, a high net worth investor comes into the bank, let's just call it Chase Bank, and they put $1 million in. If Chase wants to loan any money based on its deposits, it goes and creates the money from the deposit itself. Okay? It doesn't go lend that money. Why? Because the bank can't create money without fractional reserve banking, which means they are allowed to loan fractions of what they take in for deposits. And right now, as of the current rules, it's as much as 90% of the deposits they take in. The only other ways to go get money is through an act of Congress, in which Congress can, what they call, appropriate funds, and Congress can create what's called appropriations. And when they do that, they have what's called a spending bill. I'm sure you've heard that term. A spending bill will allow the Treasury, United States Treasury, to print money. And when that money gets printed, the Federal Reserve buys all of that money and then loans it to the commercial banks, Chase, Wells Fargo, Bank of America, et cetera, et cetera. Okay? The only other place the bank can go get more new money is to borrow money at what they call the Fed window. The Fed window is where the bank, Chase Bank, says, we want to get $900,000. So the Fed will look at, well, how much reserves do you have? How much collateral do you have? And if they have sufficient collateral, they'll lend them the money at an interest rate. The same way you might borrow money at an interest rate. Make sense to everybody?
Yes.
Okay, perfect. So that $1 million deposit goes and creates $900,000 of new money. It's brand new, just created out of thin air. And somebody, let's just say it's me, I'm going to go borrow that $900,000 because I want to go buy a building. I'm going to go borrow that $900,000. And by borrowing that 900 grand at an interest rate, I promise to pay back the 900 grand with interest. So now we go from Bank A $900,000 loan to lender. Well, that lender is going to issue a $900,000 loan. In this case, it was Bank A. It's going to take that loan after I sign the loan documents, and it's going to sell that loan. And if there's 100 lenders, everybody on this call, and 90, however many more people, when there's 100 of us, what's going to happen is the bank is going to take those 100 loans and they're going to package all those loans together into what they call a pool. And they register that with the Securities and Exchange Commission, and that pool now becomes an asset, right? Because if there's 100 of us that are paying principal and interest on a face amount, a future face amount, that pool has a future value. Does that make sense to everybody? And if it doesn't, let me know now. So everybody feels comfortable with the whole pool concept, correct?
We're getting there.
Okay. So just think of it like this. If I take 100 of your dollars and I sign what's called an IOU, I owe you $100 with some amount of interest. The bank basically offering me a loan to go buy a multifamily apartment building is an IOU. And when they have 100 IOUs, they will package all of those IOUs digitally into what they call a pool. And that pool gets registered with the SEC. And that pool has a certain amount of income that will come in every single month because we're all making our mortgage payments, our loan payments, to pay back some future value. Well, who's buying these loans? Who's buying these pools, I should say? It's insurance companies, pensions, large institutional investors that have cash to put to work cannot just go buy anything that they want with their free cash because there might be risk associated with making that investment. So they have to evaluate every single dollar that they invest against a risk-free investment. So what is the only risk-free investment that exists? Those are treasury bonds. The United States treasury bonds are risk-free investments. When I go buy risk-free bonds today, it has a stated amount of interest and it has a certain maturity. It's an IOU. That's all it is. And that IOU, when it matures, it'll pay me back all my money, guaranteed, and it's backed by the full faith and credit of the United States government. So every investment is always measured against a treasury bond because a treasury bond is a risk-free investment. So if an insurance company is sitting on $100 million of cash and they are trying to earn an interest rate, they're not just going to keep it in a checking account. They're going to want to invest that money and they're going to want to make a return on it. But before they do, they have to measure risk. Patricia was talking earlier about a closing she had. There was someone who wanted to buy a property using a loan. Well, that person buying that property who's borrowing the money is a risk. Each one of us on this call is a risk to any lender that we are borrowing money from. Why? Because we, unlike the United States government, we can't print money. But the United States government can. So it's really important that you understand that with all of the shakeup that's going on right now, with banks you hear that are failing, there's 2 so far that have been taken over. There might even be a third, but there's definitely 2 that got taken over by the FDIC. This banking concept absolutely using the fractional reserve system is how we are able to grow our economy. By creating money out of thin air and then lending that money is how we all can buy and sell properties. And not just that, but it's also how we can buy anything like a car, anything that requires a loan. So these IOUs are critical to the economy, and the entire banking system is tied into our economy such that if we want to grow our economy, the only way to do that is to give access to capital to people who are making investments. In this case, we're talking about making multifamily investments, buying apartment buildings, and needing that $900,000. But the only way to get there is by the bank creating that money out of thin air. If they don't create that money, or they make it so hard to apply for it, you cannot grow an economy. You cannot have transactions. Does that part make sense to everybody? Because I want to slow down, just covered a lot of info, and see what questions you might have so far.
I have a question, Paul.
Yeah, sure.
And I guess it's not exactly about what you just went over, but because a lot of people were in forbearance programs the last year, not just last year, but even before that. Do you think that by putting the borrowers, so normally we make our payments every month. In this case, there were some that didn't make payments for a year, right? So they're not paying any interest or principal on their loan. And so the loans that, let's say like the pool you were talking about of loans that were sold, those insurance companies and, other investors are waiting for those payments to come in, right? Because that's how they earn money off the pool loans. So do you think that the borrowers coming out of the forbearance or maybe even extending it had an impact on the banks not possibly receiving the income they thought they were going to get?
That's exactly correct.
Oh, okay.
If there's 100 of us in a pool together, let's just say or even if it's just everyone on this call, the 6 or 8 of us that are on the call, if the 6, if one of us stops paying into the pool, whoever owns that pool, who's now losing income from the one person who's not paying, like let's just say I decide to stop paying, but everybody else is paying. They are no longer receiving the yield, the return that they expected to collect. And because they are not collecting the full amount, they may decide to sell that pool because they say, this really didn't work out the way we thought it would, because now we have 1/6 of the pool is not performing. Have you ever heard of performing and non-performing loans? Performing means people are paying them back according to the terms and conditions. Non-performing means that they're not. So if I'm not paying out of the 6 of us, and the person holding the pool says, with Paul not paying, this isn't really that great of a deal. I'd rather take my cash and invest in a performing pool. So what will they have to do ultimately? They'll have to sell the pool for probably less than they paid. Why? Because I'm no longer paying. And since I'm no longer paying, they're selling at a discount. And you asked me a really great question, because this is exactly what just happened with the Silicon Valley Bank. Silicon Valley Bank found itself selling treasury bonds that even though they're no risk in terms of being paid back, they have a certain what's called price. Okay, it's based upon a net asset value. It's based upon a net income that they're going to receive, and they happen to be selling at a time where bonds prices were already going down, and they had to sell a large amount of them very, very quickly, a large amount very quickly. And if you have a massive exposure to bonds that you're trying to sell in what they call extreme market conditions, where like I said right here, and let me kind of just highlight it. The pool has a price. And if you're trying to sell large volumes of anything, and in this case it was treasury bonds, the price will have to be adjusted downward. That's called taking a discount. Another way of saying it is it's like taking a loss. This is no different than if we during COVID had decided to buy 100 rolls of toilet paper because we heard, hey, toilet paper is going to be impossible to be able to purchase in the next 6 to 12 months because all of the toilet paper is made out of China. So let's just say we bought $10,000 worth of toilet paper. But all of a sudden, 3 months later, we hear that there's this plentiful supply of toilet paper now coming out of Vietnam. And on top of that, it's even cheaper than the toilet paper coming out of China. Well, what is the marketplace going to do? It's going to start buying toilet paper out of Vietnam and not out of China. What are all the China distributors of toilet paper going to have to do to compete? They're going to have to drop their price, right? The price goes down whenever there's an alternative in the marketplace that is perceived as being of equal or greater value. Does a Toyota have the same value as a Mercedes in the marketplace? No, they're not perceived the same, at least by most people. But toilet paper A versus toilet paper B, well, that might be a lot closer in perception of what we think. So if you can buy the same amount of toilet paper from a Vietnamese distributor for $5,000 that you used to buy from China at $10,000, you're going to buy from the Vietnamese distributor all day long. As long as you perceive that the value is of equal or greater value to you. And when all the marketplace agrees, you have consensus. What's the biggest problem right now with these two banks being taken over? We don't have consensus on what's happening. And that's why it's causing confusion to a lot of people, because we just saw two banks over the weekend get taken over by the FDIC. And when that happened, it caused a lot of confusion for everybody. But make no mistake, this process of banks, going back to the beginning, of taking deposits and loaning out those deposits in the form of creating new money, this process cannot go away if we are to survive as an economy. And if it does go away, then what will we do? We'll have to find an alternative, just like I was saying before, between buying the two different toilet papers. Now, I'll talk to you about that in a minute, but does everyone understand what I just said? And if I didn't, I'll slow down and go back. Okay, so let me just highlight this, and got something in the chat. It says yes. Okay, thank you. Thank you, Cynthia. Okay. So when selling happens in an extremely short period of time, the price of anything will fall very quickly. And it can create such amount of volatility, price volatility, that it catches the attention of the entire the entire marketplace, basically. Okay, so I think everyone understands that at this point. So you might be saying, well then, Paul, where are we going to get our loans from? If it becomes so hard for us to be able to buy buildings, buy homes, the next logical alternative, the most obvious, is from people who already have equity. Even Patricia's seller, who was in pre-foreclosure, had equity. Now, granted, they weren't making their payments, so their lender was forcing them to take action. Hey, either sell your property and get us paid, or start making the payments and get us paid. Either way, we want to be paid. That's what the bank was saying. They want one of the two. Does everyone understand that process? Okay. So the next most drastic frontier that we will fall into, if the banks start making it so hard because of all of this volatility, which I think honestly it's going to blow over. I really do, but I don't have a crystal ball. And unless they change the rules to the fractional reserve system, which is how up till this point, ever since the Federal Reserve was created, that's how the money supply has mushroomed. Unless they change all those rules, that is how things are going to get financed. Even when you buy a car, it's the same thing. If you take a $10,000 car loan to buy a $20,000 car, you put $10,000 down and you finance 10,000 of it. The bank is creating that money out of thin air from deposits. It's not sending the money over to the car dealership. It's creating new money and sending the new money as a credit to that business. And that business gets credited. And when they check their bank account the day after you buy your car, they'll see your money there in their bank account. That's a credit. That's a credit off of the loan you received to buy your car. If all of that goes away because all of a sudden the banks decide to make lending more difficult through tougher underwriting, you can always make an offer on a property subject to the existing equity that the seller has in the building. So what might that look like? Well, in a worst case scenario, it just looks like this. Let's just say a seller is selling a multifamily building, apartment building, for $2 million. And let's just use an easy example. It's a free and clear building. They don't owe any debt on it, and they just want to sell it. Well, one of the very first ways of buying a property is just asking the seller, look, if I make some kind of down payment, if I put a certain percent down, will you finance me? At some percentage, and I said X percent. Believe it or not, this is how some people get in the business, because they can't go to a bank right now because they have such bad credit, terrible credit, or rebuilding credit. I'm sure some people on this call, maybe you don't have perfect or stellar credit, or maybe you're rebuilding credit right now, and that's fine. So the very next thing you can do is just go to the seller and say, look, since you've got some equity in this property, I would like to buy your building. If I put a certain amount down, which you may need to go get a partner, okay? You may need to get a partner. So maybe some partner puts the down payment down, that you'll be able to buy this building with that down payment, and then the seller will give you what's called terms. What are terms? Well, the terms are right here. For the next 5 years, you're going to make payments at a certain percentage of interest rate. Or maybe instead of making monthly payments, maybe you're going to make only one payment at the end of the 5th year. Does that make sense to everybody? Questions, comments?
Yes.
Thank you, Cynthia. Let's take another building. You want to buy a $2 million multifamily building. And let's just say there's $750,000 of debt on the building. Well, if you would like to finance, so your goal is you would like to have the seller finance the deal with partner putting, let's say you cut them in it. You know, you've asked them to put 20% down, but you'll cut the deal 50-50. So let's just say they're gonna make a 20% down. Well, what the seller would do in this case is they might respond to you, there's no way we can do this because this is a $750,000 debt that's already sitting there. So maybe you can ask them to move the debt to a different property. I've done this before. I asked a client one time on a building that we were involved with, just like this. I said, you know, the bank offered us a really great deal recently. I would like to be able to move your loan, because I don't want to pay it back. I'd like to be able to move your loan, Mr. Lender, to a different property so that I can go get this really great interest rate and do a cash out finance deal on that building. So what we did is we moved the debt, the $750,000 debt, to a different building that was free and clear. Now, sometimes you can't move a debt because the lender won't allow it. What's another thing you can do? Oh, I'm sorry, subordinate. You can subordinate the loan, the existing loan, with a second. Put a second on the debt, put a second on the property such that when you go to make your payment, you're paying a second and a first. Or
Here's a
sometimes,
question.
go ahead. Mhm.
Why would they want to do that? Is it because they know that they're going to get the additional business from you? And I'm assuming that they deem you credible, you have a good history with them or whatever, or is it the deal itself they see? Why would they move it? What's the incentive for them?
Because in a tough selling environment where they may not be able to get the 2 million, maybe you're the only one offering 2 million because the marketplace, like it is right now, just is not chock full of a lot of buyers. There's just not a lot of offers coming in for $2 million. But lo and behold, you came forward with a $2 million offer. And since they don't need the $2 million to be in their bank account by tomorrow, they're fine if somebody makes payments for the next 5 years, because those payments are still going into their personal bank account, helping them to pay their expenses, their daily expenses, monthly expenses, and it still leaves them enough left over to not have to change their lifestyle. Remember that when you offer to buy a building for $2 million, that gives the seller not only their sale price, but it also gives them another decision of how to allocate that $2 million. That seller now has a problem. They've got to figure out what to do with it. If I owned that $2 million building and I was selling it to you, and you said, I'll pay the $2 million and I'll get a bank loan and I'll close in 60 days. I say, great. You know what I'm thinking about now? I'm thinking about, okay, what am I going to do with that $2 million? Especially if the stock market's not performing well. If interest rates are starting to climb, and I don't know I don't have any idea where interest rates are going to go. And, maybe I don't like the prospects of gold. Maybe I don't like the prospects of silver or Bitcoin. But I still got to do something with that $2 million once it hits my bank account. It's a lot of money. So if I know that I don't have to change my lifestyle, I'm totally fine moving that debt and offering that deal to you for you to buy that property for me because you're promising to pay for it and you're going to pay for it within 5 years. I'm going to lock in my price. That's a done deal. And if you don't pay me back, what is my remedy? My remedy is I'm going to foreclose you and I'm going to take the property back. I'm going to take my own property back and do it all over again. And I'm going to keep all the money that you ever paid me in principal and interest because you defaulted on the terms and conditions of the loan. So this is a great deal if it does not disrupt my lifestyle. Because that $2 million, that contract locks in between you and me. It locks in my price. So even if the whole world is going to hell around us, that contract says you got to pay me $2 million. And you're going to pay me interest over the next 5 years at a certain percent. So it's a great deal for a seller who's not getting offers. It's a great deal for a seller who maybe they're getting lowballed. Maybe instead of getting offers at 2 million, maybe they're only getting $1.75 million or $1.8 million. And maybe that seller, maybe I feel like I'm being cheated by not getting a minimum of $2 million. Because I feel that the market, even though there's a lot of uncertainty, when the uncertainty calms down, that the market's going to show it's definitely worth $2 million. So there's a lot of benefits to a seller. But the seller has to perceive that the contract that you're agreeing to is of equal or greater value to them in their perception. I recently met an Arizona investor who wanted out of the landlording business altogether, and I wrote them an offer, and it turns out they got 25 offers. Unbelievable, 25 offers in this market. But they were willing to offer seller financing, and actually they asked for seller financing of a minimum of 1 year, and they preferred 5. Why? Because they knew they were going to get interest payments, principal payments, they were going to lock in a price, and none of this was going to disrupt the quality of their living. And on top of that, one of the most important, they didn't want to have to go figure out what to do with, that was a $1 million deal. They didn't want to have to go figure out what to do with $1 million right away because they didn't have an idea. They just wanted out of the landlording business. They did not want to have to deal with property management anymore. They had hit a point where they had no more bandwidth to be a property manager. They were done, finished. Great, that happens to everybody. Sometimes we're done with things. And you guys would probably agree. Sometimes you've done things for a certain amount of time, then you decide, you know what, I don't want to do this anymore. And it's because you want your lifestyle to be a certain way. So those are the reasons, and I hope I answered your question.
Hey, Paul,
Definitely.
hey, Paul, can
Thank you.
You're welcome.
can I add a comment here?
Yeah, please, go ahead.
Another big reason for seller financing is the tax deferment or lowering the capital gains on the sale. Is that also a good reason for seller financing?
You know, it is, but here's what I'm going to tell you. I'm going to defer conversations about taxes to your CPA because, number one, I'm not a tax person. I love my CPA. I've got a great CPA who works out of the San Fernando Valley. It's my least favorite subject to try to understand. So for me, it's like whatever I pay my CPA, it's so worth it. Are there tax advantages to what we're doing here in the world of real estate? Absolutely, there are. But I never make tax decisions about investments unless my CPA stops me to say, wait a minute. There's something I need to tell you before you pull the trigger. So I do consult with my CPA, and I hope you're all doing the same thing yourself about almost everything you're doing that has to do with major amounts of money. You're checking with them, just let them know, hey, this is what I plan on doing. Would that hurt or help me this year? Or to be neutral? Or to mean nothing? Right now, gang, there's a lot going on with banking. Things are volatile. We might, over the next week or two, hear about a couple more banks that fail. And that failure can be for a number of reasons. Silicon Valley Bank's whole issue had a lot to do with the large amount of treasury bonds that they were selling in a short period of time that were losing value. And because they started losing value, the bank had no way to hedge against those losses. And that's why the FDIC had to take them over. Check with the FDIC website, but remember your deposits in checking accounts and savings accounts, for basic accounts, not investment accounts, is $250,000. And if you're unsure, go to the FDIC website, FDIC website, and read it for yourself, okay? But what we're talking about here today is that what's going on, sure, more could unfold, absolutely. But this process of banks creating money out of thin air, we depend on it in the investment world to buy and sell these buildings. Everybody does. And if that starts becoming difficult and hard, then this whole seller financing is going to be our way through as one way, as one of the alternative strategies. This call today, we've gone almost an hour just talking about this one thing. And I hope I haven't wasted time over explaining things, but I just tried to really make it as super easy as I possibly can to help you understand it, because I think that it's a topic that can be really well misunderstood if you don't have a banking background. And by the way, I don't have a big banking background either. I had to learn a lot of this from my investors. So we're coming up on the top of the hour, and I've done a lot of talking. What comments or questions? But thank you, by the way, Mud, for your comment. I appreciate it. Anyone else? Comments, questions, feedback on? I hope this was helpful. Was this helpful for everybody today?
I'd say this is very helpful, and I thank you very much for just breaking this down and just explaining it in very plain English. I'm a lender, and everything that you're saying is super relatable and very easy to understand. And had I taken the approach that to watching this video maybe 8 years ago before I got in lending, I would have been well advanced and equipped. So thank you for all your insight, expertise.
Oh, sure. Yeah, thank you. Are you a mortgage lender, or do you lend to consumers or investors?
I actually don't deal with mortgages. I'm a credit card lender for consumer and businesses. Yeah, so a little different criteria, of course, than the mortgage criteria, but definitely the same means of garnering our interest and late fees and things like that add to our bottom line to help us really grow as banks. So
Yeah.
good stuff.
Yeah.
Interesting business.
It absolutely is. And thanks again for joining the call. Anybody else? But like I said, this is, look, if you want to get your first multifamily investment deal, absolutely right now, on every single deal, your very first offer should be, can you offer seller financing? And if so, if we do this seller financing, what are you going to require of me? And when can we close? Don't even think about the banks. But if they say, no, you're gonna have to go get your own loan. Okay, fine. Well, then you're gonna have to go through the process just like everybody else, 30, 60, 90 days. I would give yourself extra time. I'm not even kidding you. I started a loan application, no joke, in November. And we are just finally getting ready to close on the 20th of this month. No joke. This has been forever. I've never gone this long on a loan.
Question: are you guys seeing lender constricting or changing things in the middle of your deals or anything like that right now?
What I'm seeing is just lenders finding ways to delay processing. That's what I'm seeing. But that's all multifamily type stuff. I haven't had any residential loans out there, so I can't speak as an expert on residential loans, but on just multifamily loans, what I've seen is just all sorts of reasons for delays. Holidays are to be expected, so I don't blame the holidays. I mean, I know that around the holidays things always slow down. Staffs get reduced, people travel, people vacation, people holiday, people get sick, unfortunately. But what I've noticed is just absolutely, I would be writing offers. 90. It's going to take us 90 days to close if we're getting a bank loan. We'll try to do it earlier, but honestly, the banks have just taken a long time. And like what Patricia said earlier, it's really true. It could be because there's a bunch of stuff going on in the background with the bank that we don't know about. We're not privy to it, but we'll never know. And it's not our job to find out. All our job is to figure out is what's it going to take for the bank to get us this. So maybe have 2 or 3 applications working at the same time all the time.
Thank you.
Sure. Anybody else?
I had a quick question. You mentioned that there may be a third bank. Do you know which bank that might be?
No, I don't. I don't have any idea. The Silicon Valley Bank had a high exposure to long-term treasury bonds.
Mm-hmm.
So that tells me a clue that any bank with a high exposure to long-term treasury bonds may be in a similar predicament. I just don't know. But that to me is a clue. Don't forget, even though the value of bonds go up and down, they are guaranteed to pay. And the U.S. Treasury has never missed a payment on the payment of any Treasury bonds or Treasury bills. So it's important to note that if these banks can hold to maturity, they're going to be fine. They would be fine. So I don't, off the top of my head, I'm not even, Patricia, it's a great question. I'm not even paying attention to the banks in that way. I'm just being careful and cognizant of the $250,000 threshold that I never think about exceeding how much the FDIC will protect me in the event that all of a sudden this whole thing blows up. Because if it does blow up, what else can we do? What else can we do? A lot of us keep our money in the banks. So, and do I think people are going to start trading in some alternative currency? Well, technically speaking, you could trade a person your property for their property, and that's a form of barter. But it's very, very rare that sellers could meet each other, like for like in that manner. So I don't know of any, and I really hope it's the end. Honestly, I really hope it's the end, and not because we bail them out, but because honestly, the FDIC just comes in and does what they're supposed to do, which is they're supposed to protect the depositors. And my understanding is that they're going to come in and protect anyone who had 250 grand or less. They're going to come in and protect all those people. Now, if they protect more people, well, then technically, where are they getting that money from? Then it's coming from the American taxpayer. So I hope it's not a bailout. I really do. But I just wouldn't be surprised if there's more. I just wouldn't, because there's always that possibility that, hey, this was maybe something that was going on with quite a few of them, and maybe they were kind of under the radar. And I don't think I think the banking industry is far from being under the radar at this point. I think a lot's going to get exposed in the next week or two. So, I think, does that change what we do in terms of trying to invest in real estate? No, because if you have a good real estate investment at the end of the day, over the long term, real estate has always been a really great investment vehicle to create wealth with. So, me, I'm charging forward. I hope it's the right call, but You know, you gotta just evaluate what's going on for what it is. And the way I see it is, I don't see fractional reserve changing. And if it does, well then fine, we're gonna have to new rules, and we'll all have to abide by them, and we'll all have to learn them. But until then, these banks need to make loans. That's how they make money. That's how they grow. And if they start shrinking, they're gonna close. And maybe even a good time to check out your local community bank, you know? Maybe have a small account with a small community bank that's only in your community, that's FDIC insured. Maybe it's time to create a new banking partner, just in case. So thanks for the question. Anybody else? Okay, great. So next week, I think Annabelle will be back on. I hope this was helpful. Again, it's really important to understand just, the whole financing world and what we do. I don't really think what's going on impacts us greatly. We might see lending guidelines change, and if so, we're going to have to adjust a little bit. But I don't see loans drying up tomorrow. If they do dry up tomorrow, then it's because there's some other black swan out there that we cannot see, because I don't have the crystal ball. And if someone did, I would be happy to share it, but I just don't. So until then, we just have to make smart decisions, make sure deals pencil out, and keep doing what you're doing. So we'll see you all next week. Thanks very much for everybody joining, and thanks for the questions.
Thanks, Paul.
All right, you're welcome.
Thank you so much.
You're welcome. See everybody.
Bye.
Bye-bye now. Take care.